Hello all, and welcome to our interview and presentation with Rick Curtis. Thanks for being here, Rick.
Thank you, Chris.
Now we'll just have a bit of a chat before we get the viewers coming on board. There's quite a few that are logged in, but we'll just wait a few minutes. So, how'd you find the traffic getting here, Rick?
Very scarce at the moment.
Not much traffic, huh?
We're in Melbourne and we've still got restrictions.
So whereabouts are you from?
I'm from born in Melbourne and I live in Camberwell, Melbourne.
Excellent, that's where my wife grew up. I think we discussed that. Now, so we're going to obviously get into the main things with Bensons, and we're really happy to be in this partnership. So, yep, we've got quite a few come on. There's over 100 now. You happy to begin, Rick?
Certainly.
Excellent. So I'm joined here by Rick Curtis, who is the Managing Director of Benson's Property Group, and you have been for 14 years. You've been in real estate now for 35, finance and management. So tell us a bit about your journey, Rick.
Well, I originally started in finance law. I then moved to banking in South Australia. I then got the development bug and moved across to Coles Myer. So I did a lot of shopping centre and commercial developments. Yep. I was then CEO of Centuria Capital, which is a listed Australian property and funds management group. And then I came across to Bensons 14 years ago, really to get back into development as well as do some funds management.
Fantastic. Now, obviously, you've been in real estate for 35 years. Myself, 21, so that's almost 6 decades of experience. Now, you also heard you're a Collingwood supporter. You're not a big fan of Eddie McGuire, is that correct?
No, not a big fan of Collingwood, but not necessarily Eddie. I think he's been around too long. 20 years with one premiership just doesn't fit the bill. Look,
I can relate that both my brothers are absolutely fanatical Collingwood supporters. Everyone always asks me, who do I support? I'm embarrassed to say I don't know anything about football. I'll even share a funny story with you. My oldest brother's 12 years older than me. He coaches, they watch every single game. I'm at his son's 21st, and there was 4 gentlemen that I didn't recognise, and I said, Pat, who are those guys? It was Dane Swan and 3 of the Collingwood supporters, and I didn't even recognise them. So there you go, there's my Collingwood story.
All right, so your education is not quite finished yet?
Absolutely not. When it comes to sports, there's not many sports that I know of. Martial arts and Q sports are the only 2 that I actually followed all my life. So okay. Now, so let's get into it, Rick. So let's rewind back to March. We had whispers that there's a potential pandemic in the air. It's going to affect the property market. Fast forward to where we are now. How has COVID actually affected a group like Benson's?
Well, firstly, from March, our first priority was really the health and safety of our employees, our customers, and our suppliers. At the same time, knowing that there was going to be an interruption in business, we wanted to make sure that we could service the needs of all our business associates. So we did what is now standard practice in terms of educating staff about hygiene and cleanliness and social distancing, then getting as many to work from home as possible, equipping them so they could actually work from home, banning travel, banning direct meetings and the like, all of which has become sort of standard at the moment. So that's from an operational point of view. From a business point of view, as I said, we've tried to move everybody at home, try to digitalise the business. But from a normal operational point of view, it actually hasn't affected us that much. We've got 2 projects under construction, one at Footscray and one in Hawthorn.
Which we're talking about one of them today.
Yes. Neither of them actually been delayed by COVID. Wow. And from a sales point of view, we're actually continuing to sell well, particularly at a Footscray project. We've already sold out our Hawthorn project.
Which is fantastic. Now, for those who don't know, Bensons have over $1 billion currently under construction. You focus mainly in Victoria and Queensland, is that correct?
Correct, predominantly Victoria. We're a Victorian-based company.
And the project that we're talking about today is Liberty One.
Correct.
Now, let me ask you, Rick, so being 35 years you've been in the industry, I know you've been the Managing Director for 14, you've seen a lot of ups and downs in the market. So how was this pandemic, because I guess this is once in a lifetime for us, how do you compare this to like a GFC when it comes to property market, property prices and buyer sentiment in general?
Well, every economic cycle has a different reason behind it. GFC, or as they call it, global financial crisis, was really a credit crunch brought about by the collapse of the wholesale securitisation markets. As people might know, that led to a lot of overseas banks going broke, being taken over by their home governments in England, in Norway, in Netherlands. But in Australia, our banks had learned the lessons from the 90s and were very strong. So none of them went under. it just became more difficult to raise money. For projects, to develop projects. But in terms of sales, it didn't actually have a lot of effect on the residential market. The residential market at that time remained reasonably buoyant.
Because I guess there's a couple positives there. Because obviously, if less people are developing, or there's harder to find funds, the supply is going to go down, so the demand will go up. But also, I think in Australia, due to APRA and also the lending being at 0.25%, there's a lot of positive signs to get into real estate now as well.
Correct. I think COVID-19 is, in one sense, a short-term impact. The property market works on longer cycles, just as people investing should work on a longer cycle. The actual residential market has actually held up quite well in terms of the impacts of COVID-19. What it is affecting, I think, it will be the supply. So there's a lot of projects that have been put on hold. A lot of people aren't developing and building, and that's going to put out of balance the supply-demand. So I think we're going to see an upside from next year on.
And for companies that like Benson that have over a quarter of a century of experience, it always holds them in good stance when they run into like a GFC or say a pandemic, even though it's uncharted territory. Having that sort of history and that sort of backing and that sort of knowledge, it's always better to navigate through uncertain times like this, deliver projects and selling projects.
Sorry, Chris. Yes, correct. I mean, we understand the cycles. We have very good relationships with our key lenders and investors as well. So from our point of view, it's all about the fundamentals of the property market in terms of demand and supply. And as I said, Victoria continues to grow and that demand will show through.
So basically, besides obviously we've had to change the way we do business, the new normal's different. In terms of sales and for people that deliver good projects, you don't feel that the sales have slowed down at all?
No, we've actually seen good sales, particularly on, as I said before, on our Liberty One project in Footscray. And I think the reason for that is that the market had a down period, the bottom cycle in 2018 and early 2019. We were seeing a return in the upside of the market at the end of 19, and investors who had stood out of the market for 18 months, 2 years, have started to come back in the market.
And just for the people that own Liberty One, it's located in Footscray, which is west of. Tell us a bit about the area and why you chose to develop there.
Well, Footscray is the new rejuvenation area. It's one of the few suburbs that is only 5 kilometres from the CBD. 5-6 years ago, it was not possible to develop larger projects there, but because of a number of government initiatives, the closest parts of Footscray to the CBD, which is where we are, and it's called the Joseph Street Precinct, has actually been rezoned. So you're going to see a lot of development, and as I said, the advantage is it's actually the closest part to the CBD.
And you're seeing a lot of, if you're looking in a radius around the city, it's within a 5 kilometre radius, as you said, and it's all part of the Western Growth Corridor region. So there's a lot of growth in the West, and I think it's an affordability factor. You mentioned a number of the factors as well, and you're seeing Footscray as a big boom market. We've been in there for quite a few years selling now. So obviously developers like Bensons and other likes are going there because they're seeing all these growths. It's also an educational hub. I read there's 23 universities and schools in the vicinity. So there's a lot actually going on there.
There is, and also the state government. There's slated to be over 30 billion worth of new infrastructure projects over the next 10 years, including a $1.5 billion upgrade to the Footscray Hospital, which is only less than 3 kilometres from our site.
And obviously where there's infrastructure spend, there's job creation, there's people moving there, there's supply and demand. And I also feel that when you go into Footscray, it's changing a lot. There's a lot of trendy cafes opening up. It's becoming a much more desirable place to live. As the prices rise there, it also changes an area drastically. And you're seeing that with Footscray now, and I guess in the few years we'll accentuate that as well.
Well, yeah, correct. And if you look at the Joseph Street precinct itself, it's got over 12,000 square metres of retail, cafes and the like slated for that area.
Yeah, and look, we did mention Covert at the start of this presentation, but one thing I do find as someone who sells real estate, there's a lot of great opportunities for investors and buyers now because a lot of developers are willing to do deals or willing to give incentives they weren't willing to give prior. So for people like us offering our clients incentives, we're going to discuss a few of them now, it's a great time to get into the market. And I think the key thing to focus on, or which we tell all of our buyers, real estate's always a long-term proposition, 7 to 10 years. And if you look at any GFC or any massive economic shift, Residential real estate has always held strong. If you look at the share market, which has taken a massive hit, people feel a lot more confident putting their money in residential real estate because it's tangible. And I do feel that being that it's a long-term proposition and the share market getting so much fear in it because people are losing so much money, residential real estate is a safe bet. And you also mentioned the much more limited supply. People still have to live somewhere, and people are still buying houses because they have to, or apartments, so to speak, dwellings to live.
Correct, Chris. I mean, as I said before, the fundamental drivers of property are firstly population growth, as well as changing demographics. What we've seen over the last 10 years is a change in the apartment market. People, and particularly a younger cohort, both buyers and renters, want to live close to the CBD.
Because there's amenity.
There's amenity.
And I learned, a gentleman was told me he focused on the pie chart, population, infrastructure and employment nodes. Now if you look at Footscray, Liberty One, obviously it's an emerging market. It's in the west, it's only 5 kilometres out of the CBD as we've mentioned. Employment strong, and infrastructure, they're spending so much money there as well. So it's obviously makes for a good story why you should invest there, or why you should consider that as an option.
Correct. So we've ticked the box, location is a great location. Then you look at the building. The building itself is 25 levels. It's got ground floor retail, including a supermarket. It's got a great common area facilities in terms of cinema, dining areas on the roof. Uninterrupted views for those that like Flemington Racecourse, and to the west as well.
And for those like people that always, the idea of an apartment being a lot smaller than a house, which is always true, but the amenity that's coming up in some of these buildings like Liberty One, it makes sort of a lifestyle choice. You can live close to the CBD within 5 kilometres. You can enjoy great views, so rooftop terrace. So, and these are generous apartments that we're talking to. All the one bedders are 50 square metres minimum, and they're very reasonably priced. So they're under $8,000 a square metre, and you've got all this amenity at your doorstep as well. Big supermarket at the bottom. So it is a lifestyle choice, and it's also good for an investor, but also good for someone who wants to live near amenity.
Yes, Chris. There's always that old argument, do I buy houses for land, or do I buy apartments really for more convenience? Yep. And as I said before, there's a younger cohort that make that difference not as much. They want to live close to the CBD, they want to live closer to the amenities, to the existing transport networks. That is driving an increase in apartment prices, whereas there used to be a difference between houses and apartments.
Yeah, I've got a couple of questions that I want to ask you, Rick. So are you finding now in this current market over the last couple of years, your owner-occupier to investment rates increasing? What would be, so a normal building, what would you say owner-occupied percentages as opposed to investor?
If we look back, so we finished a large project in Malvern East last year where we had over 300 apartments. We probably had a 60% owner-occupier and a 40% investor. In areas, but that was in Malvern East. It depends on the area. Whereas we have a project for 19 high-end apartments in Hawthorn. They are all owner-occupiers, but they're all downsizers. The average age would be 70 plus.
So it's a more affordable investment in certain areas being an apartment. Correct. It's better for security, and I can say all this stuff because I actually live in an apartment. I live 2 buildings up the road here. Better for security, it's good for convenience, and you have all the amenity as well, but it captures the downsizing market as well. So there is a lot of reasons to why people are choosing to live in apartments, especially lifestyle developments like Liberty One. You've got all this great amenity as well, so there's a lot of advantages to why an apartment is opposed to.
That's right. So apartment living has become accepted and normal, not just for the younger people, but some of the, as you said, some of the downsizers.
So it's opened up a different market as well. Now, for those who don't know, and we are taking questions, so please keep the questions coming. We'll answer as many of these questions as we can. For those that we don't get around to, please keep the questions coming, and we'll make sure that we answer them and get back to you with the answers. So please keep the questions coming. So also, most people think the $25,000 grant is only for house and land. Can you clarify that?
No. So the Commonwealth Government have put forward a homeowners grant, which applies both to house, but also to off-the-plan apartments as well.
Okay. So, and that's obviously that's a good thing for a first home buyer to get into the market. It actually gives them a big advantage. It's not just house and land. So for those who are getting into the apartment market, the $25,000 doesn't qualify for all buildings, but for Liberty One that we're talking about specifically does. So I've asked you have briefly said a little bit about Liberty One. It's got great amenity, it's got great walks courses, great communities around there. What incentives are you offering for buyers to actually get into this project now?
Well, we recently completed first stage of the release of Liberty 1 for 152 apartments. That's now sold off. What we've now done is launch stage 2. It included specific upgrades in terms of within the apartments themselves to the value of $20,000. That includes smart technology in terms of the air conditioning, keyless doors, etc. But we're also offering purchasers a $15,000 incentive in terms of whether it's applied to stamp duty or to rebate on the price.
Okay, yeah.
Plus, for those that are investors, we're also offering substantial rental guarantees on their properties.
Which basically safeguard the investment in the short-term future. Because a lot of people, the main concerns we're getting from clients at the moment, and I'm specifically talking about the investor market, because the owner-occupier market, you're not really worried about that because you're going to move in. They're worried about, what if I lose my job due to COVID? What if I can't get a tenant? So offering a $15,000 incentive, that really gives you quite a lot of time to find another job, or puts a safety net there for you. Offering a rent guarantee as well offers that security. So what would you say to someone that's considering purchasing an investment now, an apartment, into getting today's market? Is now the right time?
I think so. I think that we've gone past the cycle in terms of people now realise there is an upside to the market. The timing, it's not about whether I should buy now, it's where I should buy, all right? People need to act, all right? The biggest factor in people, as I said before, in terms of deciding to buy is where's the overall market cycle. COVID-19 is a short-term issue. We're now on the upside. No one can pick the bottom and no one can pick the top. But the savvy investors are seeing that the upside is now coming.
I love hearing that thing. And you mentioned before location, location, location. I've coined a saying that says affordability, affordability, affordability. It's what you can afford, because you will always make money in real estate. And it's a pretty bold statement, but I've said it many times. You will always make money in real estate if you can afford to keep it for the right amount of time. So if you consider all these factors and you're not over leveraging, you're getting all these great incentives, and you're buying an apartment which is essentially 8,000 a square metre, 5 kilometres outside the CBD, there's a very slim chance of you actually not making money in such an investment. And as we mentioned before, property is 7-10 year cycle. It's not 12 months. No one can predict the bottom of the market. I'm a firm believer in that. No one can predict the top. Someone always asks me when I do seminars, Chris, where do you feel the market is? And I said, I never ever get this question wrong. And they said to me, really? I'll give it to you at the end of the seminar. They go, what is it? I said, it's going to do one of three things. It's going to grow, it's going to stay the same, or it might go down slightly. And they go, thanks, Chris. I go, over 10 years, you're always going to make money. No one can predict the exact where the market is now. Is it going to go low? Is it going to go high? I don't think anybody can do that. No. Warren Buffett says that about shares. I think that's applicable to real estate. I think it's applicable to any investment.
The real decision that we've said before is about getting the right location and understanding that Melbourne is still growing. That's driving it, and the demand for apartments is growing as well.
Where are most of the buyers coming from now in this current project? Because overseas buying activity would have slowed down, I imagine. Would that be correct?
Well, one of the impacts of COVID, given that the travel restrictions, is that we're doing next to zero overseas sales. All right, it's all about local buyers, local investors, particularly for Footscray. But within that, we're actually getting a lot of buyers from Sydney, because the Sydney people look at it and say,
it's a bargain.
I can see the CBD from here. It's 5 kilometres, it's near a train line, it's got all these connections. Price from their point of view is extremely affordable compared to Sydney. Plus, as I said, we're offering the incentives on stage 2.
And if you look at it too, it's always been the case with Sydney. When they look at Melbourne price, they said, wow, because obviously they're a bit ahead of us with median house price, but I think that will change over time. But looking at a location, and again, it's in the west, it's only 5 kilometres out, to a Sydney buyer, it looks like it's half price. Correct. Considering to what they're buying, and they've had great growth in their apartments, so they're obviously optimistic, and I think they're more conditioned to Melbourne people than apartments, but I think that's starting to change now. People are more comfortable with buying apartments or living in apartments, and I think with better amenity, better buildings, like with Liberty One, it's becoming more prevalent for buyers.
It is, and if you compare to Sydney, even though we've had substantial growth in apartments over the last 10 years, we're still well underrepresented. Proportionally, we'll take another 30 years to catch up to Sydney in terms of the amount of apartments.
Do you think it'll be that long?
I think so, because we were so underrepresented in the first place. And compared, and I've looked at Los Angeles, Chicago, comparable cities, we're still well underrepresented in terms of apartments.
And I think it's like what you said too. They're a lot more conditioned to apartments than Australians are. If you look at New York, if you look at London, the prices there are obviously through the roof, but they've got a lot more age towards them than we do in Australia. They're more conditioned towards apartments. That's definitely changing though now, isn't it?
Correct.
Which obviously is going to be reflective in the property prices.
Yes, but it's not all about prices. It's more about value.
Yeah, well, look, as I've said, I think 3 times now, 8,000 a square metre, there's 3 things I always say about real estate. Cost of living is going up. Cost of building is going up. So you're going to buy the materials. They're never going to get cheaper, are they? No. And inflation's going up. These 3 points alone are always going to push property prices up. And sometimes the apartments might not be growing at rates that they should be. But to build that building in 5 years is going to be a lot more expensive than it is today.
Absolutely. And prices is not always an even growth, but if you average out over the 7 to 8 years, you always see growth in property.
And I say that too to some of my clients, and when I'm discussing with them, I go, I sold my property for the same price I bought it. I've had it for 4 years. I said, can I ask you a question? They go, yeah. What happened next 6 years? Oh, you're not going to believe it, it doubled. I go, that's what property does. It doesn't go like this generally. It happens. But in 10 years, I always say, it is going to increase substantially. But no one can predict, it's never going like this, is it? I always ask that question. It's always astonishing me, Rick, when I say to them, how did it go the next 4 years? Oh, you're not going to believe it, it doubled. That's what happens to real estate.
Absolutely.
But I guess I think in areas like Sydney, I think it's been a lot more steady. The growth's been a lot more consistent. And I think Melbourne is catching up now. And with people like overseas buyers, which now is obviously a little bit different, or Sydney buyers coming in, and our supply dropping, it can only mean one thing to prices.
Correct. I mean, as you said, in terms of replacement prices, you're not going to be able to build what we're building in 2 years' time.
And that's also reflected in the valuations, because when you see valuations and what they value the apartments for, the replacement insurance of the apartment, the replacement insurance is obviously, usually in most cases, more, which means they're saying if this apartment's totaled and we've got to rebuild it, it's worth X, which that's a good indication what something's worth as well. So I say to people, when you look at a valuation, look at what the replacement insurance is as well. Because to replace that apartment, they're saying it's going to cost X. Usually that figure's about 5 to 8% more. And I say to my clients, it's very important for you to know that figure as well.
Good.
Now, so we're going to get to a few of the questions that people have sent in for myself and Rick. So let's get to it. Now, first of all, as I said, please keep all your questions coming through. We're going to answer as many of these as we can. For those who don't, we'll definitely get back to you with the answers. So please keep them coming through. So the first question's from Sally. Thanks for sending the question in. It's for myself. How much cash or buffer should I have to put a deposit down for my first investment? Great question, Sally. I always say $30,000 is a good amount for a buffer, and leave yourself about 6 months buffer. If you're unemployed for 6 months or things weren't to go your way, give yourself about 6 months room. But if you're going to use an actual figure, a good rule of thumb, I say 30,000. What would you say, Rick, to that question?
I'd agree with you, but I'd relate it back to the percentage of the property. Always keep a buffer up, and don't forget, it's not just the price. You've got various government charges and lawyers and the like.
So above that, so when we do loans for our clients, I always allow for a $30,000 buffer. When we're doing our PIAs and that, 30,000 is the magical number, but obviously as the price increases, you want that to increase as well. So great question, thanks for that coming in. Tristan, it's a question for you, Rick. What effect did COVID-19 have on Bensons in the residential market, and what effect do you think will have in the next 12 months?
Well, I think as I said before, at the moment, apart from a business point of view, having to have people work at home, we've moved to a more digital business in terms of all documents are now signed online. We're doing all meetings through Zoom. We're doing virtual presentations rather than actual presentations. So we've actually accelerated the way we're doing business in terms of technology. From the actual market, as I said, it hasn't interrupted our construction projects. And we're continuing on, and we're actually viewing it in the next 12 months as a great opportunity to launch new projects next year. So we're actively out there seeking to buy new sites.
I like that you said that, and thank you very much for the question, Tristan, because I see that as a great opportunity for Reventon too, because essentially now people are a lot more confident with having Zoom calls. You've now become, you can speak to anybody around Australia or the world for that matter. I know the buying's totally different, but your client base is just open up. Yes, it's a different way to do business, but if you can become more efficient and be at the forefront of change, your business can obviously explode. And I don't think all developers or all people selling with us that are going to get through the next 6-12 months, which creates an even bigger opportunity for the people that do get through it.
Great, and we've seen that in other cycles. You know, we develop when we think it's right to develop, as opposed to having to do it every day. When we think the time is right now, because we've been through a slower period for the last couple of years. As I said before, we're already into an up cycle, and we think that'll rebound pretty quickly next year once the actual travel and the light restrictions are lifted.
And I think that's always a good sign to the market too. When you see your big boys like your Bensons of the world buying sites and still doing good sales, it always tells me to keep going, because if the big boys are doing it, they realise and identify there's an opportunity in the marketplace, and I think that's always a good sign. So the next question is for Johnny Sanchez, and it's for you, Rick. What are the pros and cons of buying a unit instead of a freestanding house? And I'm happy to chime in on that as well.
Well, the argument for houses has always been about land and the like. But I think, as I said before, there's a growing segment of the market that prefers inner city living and apartments. There was always a segment that liked apartments because of ease of maintenance. They're generally less hands-on maintenance is required by owners. You've got your body corporates and the like. But it's a market that is tailored to people who want less maintenance. It's a market that is also attracting, as I said, new buyers as well.
Yeah, look, I also say I think it's becoming more and more understood that a lot more people are feeling more comfortable living in apartments. And as we said in Melbourne, it's a bit more of it's maturing as a market to be in an apartment. The amenities second to none. Walk scores are great. Security is good. So there's a number of reasons. That's why I still live in an apartment personally, because I feel safe. I've got 4 kids as well, so there is apartments there's families that are living in apartments as well. Usually an apartment in a specific area is going to be cheaper than a house in a specific area too. So there's a number of reasons, but I think it's becoming more and more prevalent for people to be more comfortable with apartments. And we also saw what happened with the Sydney market with apartments, how much growth they've had. And as you stated before, I think the Melbourne market's not there yet, but I think we are going to catch up to what happened in the Sydney prices and what happened to buyer sentiment, people being a lot more comfortable with apartments.
As well, and I'd add to that, Chris, that it's actually where the deepest part of the rental market is for a lot of people in terms of students and younger people who want to live close to the action, so to speak.
So you mean deeper, you mean there's a lot more?
There's a lot more in terms of the younger cohort that don't necessarily want to live 30 kilometres out of the city. For them, living close to the city is what it's all about.
And the main thing to that we should probably touch on now that you brought it up is rent vesting is so common. So people are renting apartments as well and investing in other areas because they want to live in areas close to their work, close to where they socialise. Apartments are usually, and in most cases, going to be in better locations, i.e. closer to the city, Collingwood, Footscray like Liberty One. That's why you're seeing a lot more, especially as you mentioned, the younger cohorts renting apartments. And I mean, I've been in an apartment now for probably 13, 14 years. And as we mentioned before, besides all the infrastructure going close to Footscray, that means there's a ton of jobs, 23 schools and universities around there, which means there's so many opportunities for students, as you alluded to as well, which is absolutely massive. This question's from Sabina. How much would you recommend saving up for a deposit? Now, this one's for me. There you go, Rick. I got a question too. Now, look, I always recommend 20% plus setup costs to avoid lender's mortgage insurance. But in the case where it's an investment and you can capitalize this LMI and you can claim it, you can basically borrow 90%. It depends on case by case because it depends on your tolerance to risk, and it also depends on your net disposable income, how much you can afford to service it. But if you had the choice, 20% plus setup I would always recommend because it always also leaves you a bit of a buffer as well. What would you say to that, Rick?
I agree. I think that's it's a smart financial way of going.
In most cases, when people don't actually have that 20% because the market's growing faster than their actual savings, getting into the market is so important because I've seen so many clients, and we've been in business for 15 years and helped over 3,000 people that are trying to outsave the market. I don't think you can outsave the market, especially if the market's growing, because by the time you save 10 grand, if the apartment's gone up 15, it's going to take you forever to get in the market. So I think it's important to actually get into the market. And I mentioned that before, affordability is key. If you can borrow 500, borrow 400 and pay it off a lot quicker, which means you're a lot more less susceptible to risk and not over leveraging, which is something I talk a lot about. The next question's from Ying. Rick, you're back on, mate. What are the benefits of using a mortgage broker instead of going to a bank? And I'll answer that as well.
Well, I think you answered it, Chris.
All right.
Really good answer.
All right. Now, look, going to a bank's going to offer you traditionally 3 ways to pay off a home loan. There's hundreds of different alternatives to pay off a loan. Now, if you walked into the CBA is not going to say, hey, ANZ's offering you a better product. A mortgage broker is there to assist you, a good mortgage broker. Not all mortgage brokers are created equal. Now, a bank's goal is for me to pay as much interest as I can over as long as I can. A mortgage broker's interest is for me to borrow more money and to grow my wealth. Their interests are aligned with mine. The banks aren't. So I think it's always important to use a good mortgage broker. And also, you don't pay a mortgage broker. A bank or the lending institution does. They get paid an upfront and a trail commission. So getting that independent advice, to me, is paramount, getting a good broker. Because if you walk into a bank, and most people go into a bank because they're generation bankers, because I go to the CBA because my mum shops there or my grandfather shops there, ANZ might be offering a better product. A non-conform might be offering a better product. It pays to have the information that you need. So going to a broker, I think, is paramount. Most of your buyers that are coming through, do they use brokers, Rick?
Absolutely. I mean, I'd add to your responses, try finding a good bank relationship officer. They change all the time. You want to establish a relationship with a financial advisor and a mortgage broker that can go the longer distance.
And I talk a lot about that in my book because I think it's so important to establish a good team of people around you, to have a good agent, to have a good broker, to have a good accountant, to have a good financial planner, because having a good team that have your goals aligned, you're only going to maximize your output, aren't you?
Correct.
So I think having a broker is so important. Now this one, hi Kirsty, how are you? Kirsty Young, this is a client of ours. Hi Chris, I want to know, is it a bad time to buy an investment property during COVID? I know Rick's touched on that, so I'm going to throw this back onto you and I answer that as well. I think the answer is absolutely get into the market when you can afford to. So the right time to buy real estate, the answer is always the same, is yesterday. On the proviso you can afford to keep it for the right amount of time. As we've discussed, this is a long-term proposition. This isn't a get-rich-get-quick scheme. You're going to make a lot of money in a year or two. You've got to remember you're putting, there's expenses to get into the market. There's stamp duties, there's solicitor costs. So you need to give the investment time to mature if you'd actually make money. During the fact that it's COVID now, if you take a long-term view on real estate, you will always be okay. If you don't over leverage with real estate, you will always be okay. And on the proviso that you understand that, certain things can go wrong when it comes to real estate. You might not get a tenant, rates might go up, and you've safeguarded again, they got the right safety nets. I think you'll be absolutely fine. And that's what I found with all of our clients as well. What do you think about that? I know we've discussed that. What would you say to Kirsty?
Look, I agree with that. But the other factor is interest rates, all right? If you look at the 10-year rate and even the 5, they're all under 1%. So the market's saying that the low interest rates are going nowhere for at least 5 to 10 years.
And I don't even know if we've mentioned this at this show, which was very remiss of me. 0.25% cash rate is the lowest it's been in history, which means it's a great time for your money to be active in the market and earning you a better return. When you look at the rental yields of an investment, when borrowing money is so cheap, they're coming in positively geared in almost all cases. When you consider your tax efficiencies, how cheap money is to lend, the properties are coming in positively geared in most cases, which means you can pay off the loan quicker. So I say to people, they go, what if it's going to grow? I say growing an investment is only one aspect of your property. If you're not borrowing too much or over leveraging, you can pay off your mortgage, which means you're going to have a two-tone effect. The more that gap is between your debt and your equity position, the safer you are and the quicker it is to buy your next investment and your next investment. So I think that's a very important point as well. Now, this question's for me. Is it worth buying new instead of renting and investing, so being a rentvestor? Is there a high chance you may be moving for work within the next 5 years? So basically, do you think rentvesting is a good idea? So I'll answer that question, but I'm also going to ask you, Rick, how many of your buyers are actually rentvestors or owner-occupiers? We briefly touched on that. So will you move in your profession in the next 5 years? It really depends on what sort of work you've got. But if I'm understanding your question correctly, Ian, is rentvesting worth it? I'm currently a rentvestor. I just mentioned I live up the road. I rent because I I pay a small percentage of what the property is worth, under 2% the value of the apartment, and I have all my money in 100% tax efficient debt. So why reinvesting is so popular is because I invest where I feel the growth's going to be, but I live where I want to, i.e. right near my office, right near my kids' schools, and everything's in a close community. So I live in proximity to everything that I do, work, schools and things like that. What's your thoughts, Rick?
Well, I think that most investors just look at it from a straight investment point of view. As you said, they want to get into the property. They may or may not have another property, but they need to save for the future. The second factor is we actually have people the other way around. People who buy, get the first home buyers concessions, the state government grants, etc., live in it for the required period, and then they can actually lease it out afterwards.
Yep, which is true. I didn't bring that up. I'll tell you a little funny story about that. I got my first home owners grant on my 7th property. When I spoke, I was working with a finance company, said that's not possible, Chris. I called the State Revenue's office, and they said, if you can prove you've never lived in any of your properties, which I could, and they were purchased after a period of time, I still was entitled to my first homeowner's grant.
That's right. So
yes,
that's why you need a good financial advisor. Chris.
Of course. And you should always question things. I say trust but verify. So having the right team is so important. So thank you everybody for your questions coming through. Please keep them coming through. Sorry we couldn't get to all of them, but we'll make sure that we answer every question and get back to you ASAP. Now, just to do a short recap, tell us a bit about Liberty One's incentives and why people should buy now.
Well, Chris, we've just launched stage 2 of the development. We've given $20,000 worth of specification upgrades, including new and up-to-date home technology. We're offering all buyers a $15,000 rebate or stamp duty payment. We're offering long-term rental guarantees for those buyers who want confidence in today's COVID environment. Plus, for those, we're interest on deposit and free conveyancing as well. Wow. Plus, for those that qualify, there's the Commonwealth home grant of 25 grand, that's correct. And the state government is also for first home buyers is offering $15,000 incentive plus stamp duty concessions. So just to summarise, and I'm probably going to miss half of them because there's so many incentives, but at the end of this we'll actually list all the incentives. There's a $25,000 home grant. If you're a first home buyer, stamp duty concessions, another $15,000 back from Bensons, $20,000 worth of upgrades, conveyancing, also potential long-term leases if it's for an investment. I think it was up to 25 years. There is so many incentives, so we're going to itemize everything there. Please get in touch with us. For those of you that want to know more, reventon.com.au, follow our newsletter, follow me on socials. I put constant updates about real estate, property market conditions, lending environments and that. Thank you very much for your time and joining us. And Rick, as always, thank you very much. We can't shake hands, so a COVID shake. Thank you very much for your time.